Assalamualaikum class. The current lecture is about the recording of bonds payable and associated interest payable. As we know that the bonds can be issued at premium or discount, so we will go over the process of passing journal entries for both the situations. We will also discuss about the amortization of the premium or the discount and how it affects the interest expense recognized. So let's begin with the Excel sheet. We have taken this problem from Williams Haka Bettner's book, Financial and Managerial Accounting, Chapter 10, that is related with liabilities, and we are covering problem number 10.6. In this problem, we can see that 80 million bonds are issued for 20 years, means date of maturity is 20 years, or the time of maturity is 20 years, at 10% rate of interest on September 1st, 2011. So bonds are issued at September 1st, 2011. And interest is payable semi-annually on 1st March and September 1st. Bond discount or premium are amortized each interest payment date and a year end, means on both date. The company's financial year is similar as the calendar year, which is December 31st. So what is required? First of all, make necessary adjusting entries on December 31st. December 31st means after 4 months from the issuance date. Because the bonds are issued at September 1st, so complete month of September, October, November, December. So we are preparing adjusting entries after 4 months. So this is an important thing. Then a journal entry to record the payment on bond interest on March 1st, 2012. And there are two different assumptions. First of all, the bonds are issued at 98. 98 means $100 bonds are issued at 98, which means at 2% discount. And in the second case, the bonds were issued at 101, which means that $100 bonds are issued at 101 or at 1% premium. So two entries are required in each of the situation. So in the first case, first we will consider when the bonds are issued at discount. So we will record adjusting entries as well as the payment of interest related to the discount. So adjusting entry would be on December 31st, 2011. And in case of adjusting entry, the expense will be on the debit side. So bonds, interest, expense will be debited. And then as the in first case, the bonds are issued at discount. So we will record discount on bonds payable and then bonds interest payable. So this is the entry. We are going to calculate the amount. First of all, we will calculate the contract interest. Basically, the contract interest on bond is the interest which is going to be paid to the bond holders. So, and the total $80 million bond as issued. So this 80 million will be multiplied with the rate of interest, and the rate of interest is 10%. So in this way, the annual interest will be calculated. But as we know that the bonds are issued on September 1st, so we will convert this annual interest into 4 months. So we will multiply it 4 by 12. So the interest payment would be this one. Then we will calculate the amount of amortization, or you can say amortization of discount. So amortization of discount here, as we know that 2% discount is involved. So total bonds is $80 million. We will multiply it by 2%. So this 2% represent whole 20 years time period. So we will divide it by 20 to convert it into annual, and then we will multiply it by 4 by 12 because 4 months are involved. So this is the total amount of discount, amortization, or amortization of discount. So convert it into this. Then what we can do is to add in the last step, we are going to add these both amount. So this is basically the actual interest expense that is going to be recognized in the income statement. So this is, you can say, bonds interest expense. Now, these are the amount for the adjusting entry. We have just passed the adjusting entry. So this is the contract interest, which is bonds interest payable. This is the amortization amount, which is discount on bonds payable. And here, this is the total amount of bonds interest. So 2.6 million bonds is there. Amortization amount is 26,667. And then we have bonds interest expense. And then bonds interest payable is remaining. So 667. And here it is the total expense, which is 2693,334. So this is the entry we have calculated, and this bonds interest expense is the amount which can be calculated by adding discount, or you can say, in other words, amortization on discount in the contract interest amount. The next entry will be on March 1st, 2012. This is the payment entry or the payment of interest. So first we will convert this bonds interest payable into cash because this is the 4 month accruing interest. We have accrued this interest on December 31st. So bonds interest payable will be on the debit side, and the amount is same, and this amount is covering for the period of 4 months. So remaining 2 months we will record bonds interest expense, and this is for the remaining 2 months. So here the total interest expense is this amount, and this is this amount representing 4 months. So we will convert it into 2 months, which is 2693,333 divided by 2. So this is the 2 month of interest expense. Then record discount on bonds payable, and discount on bonds payable This discount we have already calculated, but this discount represents 4 months, and we are passing this entry for 2 months, for this bonds payable for 2 months, because we have already recorded discount for 4 months. So remaining 2 months. Now we are recording it for remaining 2 months. So 26667 divide by 2, and then at last, the cash will be paid. The calculation of cash payment is simple. That is 80 million is the bond, and rate of interest is 10%. This 10% represent annual interest, whereas we are paying semi-annual interest, so divided by 2. So this 4 million is the cash payment of the interest on 80,000, on 80 million bonds. The next assumption is when the bonds are issued at premium. So we are recording it for premium. This is the second assumption. So first entry is related to the adjusting entry, 31st December 31st, 2011. So we will record interest expense on the debit side. So bond interest expense on the debit side. As you can see that we have recorded discount on bonds payable on the credit side. So same premium on bonds payable will be recorded on the debit side as contrast to discount. And then bonds interest payable will be recorded on the credit side, because liabilities are recorded on the credit side. That's why. So now we are going to calculate this amount here. So contract interest price, this would be same. So um, here we can calculate it. Contract interest is same, whereas premium is just 1%. So we are going to calculate premium, which is 1% of 80 million multiplied by 1%, and this represent uh, whole 20 years. So we will divide it by 20, that is to convert it annually. And as we are recording adjusting entry after 4 months, so we will convert it into 4 months. So this is the total amount of premium. But what we are going to do, we will deduct this premium on the contract interest. So you can see this one. So this is the amount for bonds interest expense, which is going to be recognized in the income statement. As we have discussed in our previous lectures, which was related with the bond discount and the premium, we have discussed that the discount increases the amount of bond interest expense, whereas premium decreases the amount of bond interest expense. So in this case, you can see that from arrow, we just know that this is the bond interest payable. So this amount is going to be recorded on bonds interest payable side. Here it is the premium. and the bond interest expense is decreased now because of the premium. So 2653, and then premium is 13,333, and the bond interest payable is this much. So this is the entry related to the, or you can say this is the adjusting entry, which is made on December 31st, 2011. Now we are going to record the entry for the payment, this one. So payment of interest. So March 1st, 2012. So first we will convert this liability into cash, or we are going to reduce this liability. So bonds payable will be on the debit side. Bonds interest payable will be on the debit side. Bonds interest, and bonds interest expense. We are going to record interest expense for further 2 months, because this bonds interest payable represent 4 month amount. So this amount is for the interest expense amount is for the bonds interest expense. So bonds interest expense in the case of premium is 2653. 3 will be divided by 2. Why? Because this amount represents 4 month amount, and we are recording here on March for 2 months. So now this has been converted into 2 month amount, and then we will record here. You can see discount was on the credit side, so premium will be on the debit side. Premium on bonds payable, and this is the premium 13,000, and this premium represent 4 month amount, and as we are going to record this premium for the remaining 2 months, and then cash will be on the credit side. So it is, so these are the two entries that are required in two different assumptions or two different situations. In the next requirement, compute the net bond liability in these two assumptions. So we are going to calculate net bonds liability. So net bonds liability, you can see this, that first of all, we have two different situations. First of all, we have when the bonds are issued at premium or and then discount. bonds are bonds are issued at discount, and then we have a column when bonds are issued at premium. So here we are going to calculate bonds liability. So first of all, we have bonds payable. The bonds payable amount is total 80 million in both cases. In other case, we have 80 million. So this is bonds payable. Then in the case of discount, we will less discount on bonds payable. So how we are going to deduct this amount? total discount on bonds payable were um, 1.6 million. We have calculated it 1.6 million. So here I can show you calculation here, or yes, here. So the discount on, you can see that total 80 million amount multiply by 2%. So the total discount over the 20 years would be 1.6 million. We have already adjusted two different amounts. You can say that this amounts belong to 2011. This is the 2011 amount. 4 months. Why 4 months? Because the bonds were issued on September 1st. So September, October, November, December. So 4 month amount was 26,667. So we will deduct this amount from here. That is, we will deduct this 26,667. This amount represents 4 months in the year 2011, whereas the complete, because the net liabilities required on December 31st, 2012 means all 12 months are included in 2012. So one year amount is, here you can say this 16 million represents 20 years. So we will divide it by 20 to get 1 year amount. So this is the total calculation of discount. So here it is. So when we divide 1.6 million by 20, we get 80,000. So this is the way we have calculated this amount. So total net liability, net bonds liability will be, we will deduct this discount payable from the bonds amount, that is $80 million minus 1.4 million. So this is the total liability, total bonds liability, which we are going to present in dollar. So this is the case for discount, whereas as we deduct discount, we will add premium on bonds payable. So how we are going to calculate this premium? This is same almost. You can see this is the premium for 4 months. So 80,000 premium is 1%. So we will multiply it by 1%. And then we will deduct, first we will deduct the first 4 month amount of 2020 11, which is 13,000. So 13,333, and then we will deduct this 8 lakh divided by 20 amount, which is for this is 8 lakh. This is the amount of premium for 20 years. So we will convert it into 1 year. So divide by 20. So the calculation would be here. You can see, you can calculate it directly on your calculators. So this is the amount of total amount of premium which is going to be added. Summation. So here it is the total liabilities or total liability that is related to the bonds. So this is a very comprehensive and complete question. Requirement number C, under which of the above assumption, one or two, would the investor's effective rate of interest be higher? So the effective rate of interest would be higher under, I think, under the assumption one, which is related to the issuance of bonds at discount. The less the investors pay for bonds with a given contract rate of interest, the higher the effective rate they will earn. So here you can see this is the net liability, net bond liability. So that's it from this lecture. Take care, class.